Hi, in this video we're going to talk about the cost of quality, or COQ. Because lean companies rarely hold extra inventory to fall back in the event of errors or defects, they use the management philosophy of total quality management, or TQM, to focus on consistently generating high-quality products. The goal of TQM is to provide customers with superior products and services. Each business function in the value chain continually examines its own activities to improve quality and eliminate defects. As part of TQM, many companies prepare cost of quality reports. Cost of quality reports categorize and list the costs incurred by the company related to quality. Once managers know the extent of their costs of quality, they can start to identify ways for the company to improve quality while at the same time controlling costs. Quality-related costs generally fall into 4 different categories: prevention costs, appraisal costs, internal failure costs, and external failure costs. These categories form the framework for a cost of quality report. Prevention costs are costs incurred to avoid producing poor quality goods or services. Often, poor quality is caused by the variability of the production process or the complexity of the product design. To reduce the variability of the production process, companies automate as much of the process as possible. Employee training can also help decrease variability in non-automated processes. In addition, reducing the complexity of the product design or manufacturing process can prevent the potential for error. The fewer parts or processes, the fewer things that can go wrong. Appraisal costs. Appraisal costs are costs incurred to detect poor quality goods or services. These costs include inspecting raw materials, work in process, and finished goods in order to identify any product that isn't up to par. Inspection labor and testing equipment are needed for this detection process. The sooner defective units can be identified, the better. Companies want to avoid needlessly adding more downstream processing and therefore more cost to a defective unit. Internal failure costs are costs incurred on defective units before delivery to customers. For example, sometimes defective units can be repaired and then sold as perfectly good units. The cost of the repair, called rework, is considered an internal failure cost. In the worst-case scenario, a product may be so defective that it cannot be reworked and must be completely scrapped. In this case, the entire cost of manufacturing the defective unit plus any disposal cost would be considered an internal failure cost. Other internal failure costs include production loss, repairs, and idle employee time resulting from machine breakdowns. External failure costs are costs incurred because the defective goods or services are not detected until after delivery is made to customers. News reports are filled with stories of product recalls that damage a company's reputation and significantly harm the company's future sales. Furthermore, consumers have harnessed the power of social media and online ratings to spread the word to millions of potential customers about any unsatisfying experiences they have had with products or services. As a result, a company's reputation for either good or poor quality can increase at an exponential rate. To capture the extent of a reputation for poor quality, external failure costs should include an estimate of how much profit the company is losing due to having a reputation for poor quality. Shown are some common examples of the 4 different costs of quality. Prevention costs could include training personnel, evaluating potential suppliers, using better materials, preventative maintenance, investing in better equipment, or redesigning a product or process. Appraisal costs could include inspection of incoming materials, inspection at various stages of production, inspection of final products or services, product testing, cost of inspection equipment, and cost of inspection labor. Internal failure costs could include cost of rework, abnormal quantities of scrap, cost of making rejected units, disposal of rejected units, idle time caused by machine breakdowns, production loss caused by machine breakdowns. And finally, external failure cost. lost profits from reputation for poor quality, warranty costs, service costs at customer sites, sales and returns allowances due to defects, product liability claims and lawsuits, and cost of recalls. Most companies find that if they invest more in prevention costs at the front end of the value chain, like research and development and design, they can generate even more savings in the back end of the value chain, production and customer service. Why is this? Because carefully designed products and manufacturing processes can significantly reduce the number of inspections, defects, rework, and warranty claims. Managers must make trade-offs between these costs. Companies that embrace TQM design and build quality into their products rather than having to inspect and repair later, as many traditional manufacturers have done. The costs of quality are not limited to manufacturers. Service firms and merchandising companies also incur costs of quality. For example, certified public accounting (CPA) firms spend a lot of money providing ongoing professional training to their staff. They also develop standardized audit checklists to minimize the variability of the audit procedures performed for each client. These measures help to prevent audit failures. Both audit managers and partners review audit work papers to appraise whether the audit procedures performed and evidence gathered are sufficient on each audit engagement. If audit procedures or evidence are deemed to be lacking in internal failure, the audit manager or partner will instruct the audit team to perform additional procedures before the firm will issue an audit opinion on the client's financial statements. This parallels the rework a manager might perform on a product that isn't up to par. Finally, audit failures such as those at Enron and WorldCom several years ago illustrate just how expensive and devastating external failure can be to a CPA firm. Okay, that's it for this one. This video was created and narrated by Dr. Wendy Tietz. Have a great day.